We think taking on stock risk is reflective of the fact that the risk premiums in the U.S., in other words, the expected return on stocks in the U.S. versus where bonds are trading, that's a very wide number, and it's at historic levels. So what's going on is investors are reacting to reduced macro fears. Last year we had the fear that Europe would break up, that we'd go over the fiscal cliff, any number of other things that go bump in the night. And what they're really looking at this year is they're focused on the micro. Macro is no longer as important in terms of driving returns, and that's leading investors to look at the very, very wide risk premiums, and they're beginning to come back into the market to take advantage of the relative attractiveness of U.S. stocks. The expected return on stocks is, in our opinion, in the mid-single-digit range over the long term. And that, again, relative to fixed income, is a very attractive place to be. I think even though you've hit new highs on the Dow, on the Russell, you're close to doing the same thing on the S&P 500. You may well still have good returns over the long term. We think the returns are probably better internationally. That's where we're finding a lot more opportunities, and that's where we've been moving money from an asset allocation perspective. Both the developed markets, in our opinion, and the emerging markets have higher expected long-run returns than the U.S. At this point in time, we're really finding a lot of opportunities in Europe, particularly in the financial sector, and equally finding interesting opportunities in Japan, which has been doing extremely well. We are also very focused on emerging markets, but there's really an interesting dynamic that's playing out there, in that it's not quite clear what's going on in China. It would appear as though that economy is beginning to slow down some, which is really not what the consensus and ourselves were expecting, and it's having a very depressing effect on emerging market results year to date. One way to measure volatility is what's called the VIX, which is the projected level of volatility in the, as defined for the options market. And as what you're referencing is the fact that that just went below 12 for the first time. That in and of itself is not normally a signal that the market's about to crash anytime soon. We saw all through the period 2002 through 2008 exceptionally low periods of volatility for very long periods of time. It is a marker when it gets below 14 that you sort of have to wonder whether or not you're going to be faced with a correction. And I think we, along with a lot of others, have been expecting something like that to occur, if only because optimism, short-term trading sentiment has gotten so positive. The fact that we haven't seen a correction is the usual thing that happens when a lot of people, including myself, get aligned with an expectation and the market defies them by just grinding higher and up and to the right. And so we've now had 10 days in a row where the market has been up every day, and we haven't seen that since 1996. And we all know that we got a little volatility in 96, but from that we went to the 2000 peak. So maybe history's playing itself out again. We thought this year was going to look a lot like last year in terms of total returns. We're close to realizing that in the first quarter, so from here it's a little bit perplexing. Absolute valuations are sort of slightly above long-run averages. Econometric activity has been very good and has been surprising to the upside. I think what I would want to see is a sustained period of earnings revisions before I got wholeheartedly bullish, and we have yet to see that. Earnings have been somewhat problematic in terms of expectations. They've been moving down a little bit, and you have to wonder whether, given the fact that the dollar has been so strong, whether that will lead to another round of negative revisions, because a stronger dollar is usually problematic for multinational U.S. companies, which are a big, big component of the U.S. market.